What's good, Wealthbuilder Nation? We are back again with another video, and today, we are breaking down how do hedge funds actually work. No fancy MBA required. You've probably heard the term hedge fund tossed around in Wall Street movies, financial headlines, or by that one cousin who suddenly wears loafers with no socks. But what do hedge funds really do? And why do they seem like the secret weapon of the wealthy? Let's break it down Wealthbuilder Nation style, no fluff, just facts with a little flavor. But before we get into it, do remember subscribe to the channel and check out the wealthbuilderz.com. Now with that being said, let's get back to how do hedge funds actually work. What is a hedge fund? At its core, a hedge fund is a private investment partnership. That means it pulls money from wealthy individuals or institutions and uses aggressive strategies to grow that money fast, like fast and furious market style. We're talking short selling, leveraging borrowed money, derivatives, trading global investments. These are not your grandma's index funds. So who can invest in a hedge fund? Spoiler alert, not everybody. Hedge funds are exclusive. You usually need to be an accredited investor, which means you make at least $200,000 a year or $300,000 a year with your spouse, or you have a net worth of over $1 million, excluding your home. Translation: hedge funds play in the deep end of the wealth pool. How do they make money? Hedge funds are like financial ninjas. They don't just bet the market will go up. They profit whether it goes up, down, or sideways. Their motto: volatility is opportunity. Let's look at some example moves. Short selling, betting a stock's price will drop and profiting when it does. Leverage, borrowing money to increase investment size. High risk, high reward. Arbitrage, buying in one market and selling in another for a quick profit. Global macro plays, making bold moves based on economic trends. Think currency swings, interest rates, political shakeups. How do hedge funds get paid? This is where the hedge fund manager gets rich. Win or lose. They typically charge 2 and 20. Fee structure: 2% of the total assets under management AUM. No matter what, 20% of the profits they generate. Example: if you invest $1 million and they make you $200,000 in profit, they take $40,000 off the top, plus that 2% just for showing up. Now the question is, are hedge funds risky? Let's not sugarcoat it. Yes, hedge funds chase high returns, which usually means high risk. Some blow up spectacularly, Google, long-term capital management, while others make billionaires out of bold thinkers. Q. Ray Dalio, Ken Griffin, and George Soros. They're not for the faint of heart or the thin of wallet. Why do the wealthy love them? 1. Custom strategies tailored to their goals and risk appetite. 2. Diversification. They invest in places your regular mutual fund can't touch. 3. Access to alpha. That's fancy talk for beating the market. Hedge funds are part of the reason the rich stay richer. They have tools and tactics the average investor simply doesn't. Can you get in on it? Not directly, unless you're rolling in accredited investor territory. But here's how you can study the game. Follow hedge fund 13F filings, what stocks they buy or sell each quarter. Use platforms like Whale Wisdom or Gurufocus. Learn from their strategies. Apply them in your lane. Should you care? If you're building wealth from the ground up, hedge funds may not be your first move. But understanding how they work gives you insight into how money moves at the top. Wealthbuilder Nation isn't just about playing the game, it's about learning how the game is played and then flipping the board to your advantage. Want more breakdowns like this? Subscribe to Wealthbuilder Nation on YouTube and download your free Wealthbuilder Starter Kit.